Ivar Kreuger was born in 1880 in Kalmar, Sweden, into a family that operated a modest match factory. He trained as a civil engineer, worked on construction projects across 3 continents, and by his early 30s had co-founded Kreuger and Toll, a Swedish holding company that combined construction contracting with financial operations. Matches were cheap to produce, impossible to live without in the era before electrification was widespread, and tightly regulated by local governments almost everywhere. Kreuger recognized that combination as an opportunity. If he could offer cash-strapped governments large, low-interest loans, they would grant him national match monopolies in return. He would then fund those loans by selling complex securities to investors, primarily in the United States. After World War I, European governments were desperate for hard currency and unable to access ordinary capital markets on reasonable terms. Kreuger positioned himself as a private lender who could move faster than the League of Nations and undercut the rates of American government programs. Between roughly 1925 and 1931, he extended loans totaling hundreds of millions of dollars to more than a dozen governments, including France, Germany, Poland, Hungary, and Yugoslavia, receiving national match monopolies in return. Each new monopoly added a visible revenue stream to his empire, which he used to reassure investors and issue yet more securities. The logic appeared self-reinforcing. More loans produced more monopolies produced more cash flow justified more loans. Kreuger raised much of this capital in the United States through Lee Higginson and Company, a Boston investment house that was among the most respected underwriters of the era. Lee Higginson marketed Kreuger and Toll participation certificates and Swedish match debentures to American investors, including banks, insurance companies, and individuals seeking attractive yields during a period when safe returns were difficult to find. Crucially, Kreuger insisted on minimal disclosure. His financials were brief, rarely subjected to independent verification, and deliberately structured to be opaque. According to financial historian Frank Partnoy's account in The Match King, Kreuger operated on the principle that investors should be shown enough information to build confidence, but not enough to satisfy curiosity, a philosophy that depended entirely on there being no law requiring more. At the time Kreuger was selling securities in America, the United States had no federal statute requiring public companies to have their accounts audited by a genuinely independent certified accountant or to file standardized financial disclosures with any government agency. The New York Stock Exchange maintained voluntary listing standards, but these had limited reach over foreign issuers like Kreuger and Toll. Kreuger exploited this gap methodically. He maintained separate sets of accounts, created dozens of subsidiaries across multiple jurisdictions, and routed intercompany transfers in ways that made his consolidated finances opaque even to sophisticated analysts. Lee Higginson conducted its own periodic reviews and repeatedly concluded the empire was sound, relying primarily on documents that Kreuger himself supplied. The Great Depression changed everything. As commodity prices collapsed and European governments faced their own fiscal emergencies after 1929, the actual cash flows Kreuger needed to service his outstanding securities shrank sharply. Simultaneously, American capital markets froze, making it far harder to roll over maturing debt by issuing fresh securities. Historians examining the Kreuger case have argued, though the precise timing is contested, that by 1931 the empire was genuinely insolvent beneath its reported figures. To maintain the appearance of solvency through that final period, Kreuger produced forged Italian government bonds that post-mortem auditors, as documented in accounts by Partnoy and others, estimated at roughly $142 million in face value. He was manufacturing the collateral his creditors expected to see. On March 12, 1932, Ivar Kreuger was found dead in his Paris apartment from a gunshot wound to the heart. Swedish and French investigators concluded it was suicide. A small number of later researchers have raised questions about that finding, but the mainstream scholarly consensus, reflected in accounts by Partnoy and Robert Chaplin, who wrote a detailed 1960 account of Kreuger's rise and fall, accepts the suicide conclusion. Kreuger was 51. Within days, auditors and creditors began examining his books in earnest. What they found stunned financial observers across 2 continents: fabricated account entries, forged government securities, intercompany loans that offset each other with no underlying economic substance, and assets that existed only on paper. Kreuger and Toll shares traded in Stockholm fell to near zero within weeks of the discovery. International Match Corporation, the American entity through which many investors held exposure, became worthless. Lee, Higginson and Company, which had staked its reputation on Kreuger's creditworthiness and had no independent verification to point to in its defense, was destroyed by the resulting legal claims and reputational damage and ceased operations. Estimates of total investor losses vary considerably across different historical accounts, with figures ranging from roughly $250 million to several $100 million depending on which creditor classes and jurisdictions are included. The uncertainty in those figures itself reflects how poorly documented his true position had been. Sweden's government was compelled to step in and restructure the operating business of Swedish Match, the subsidiary that had genuine factories and genuine revenue beneath the fraud. The Kreuger collapse arrived precisely as the United States Senate was accelerating a broad investigation of Wall Street practices under counsel Ferdinand Pecora. The Pecora Commission hearings, which ran from early 1932 into 1934, examined how Kreuger had been able to sell opaque securities to American investors without any mandatory independent verification, and how Lee Higginson had vouched for him on the basis of unaudited figures he supplied himself. The hearings placed the absence of federal disclosure requirements in direct public view alongside other documented abuses by major American financial institutions. Legal historian Joel Seligman, in The Transformation of Wall Street, identifies the Kreuger scandal as one of several significant catalysts that built congressional support for new federal securities law, alongside testimony about banking and trading trust abuses by American firms. The Securities Act of 1933 required that any company selling securities to the American public file a registration statement containing audited financial statements prepared by an independent certified public accountant. That requirement addressed precisely the failure mode Kreuger had exploited. No one had been legally compelled to verify his numbers before investors purchased his securities. The act also imposed civil liability on underwriters who sold securities based on materially false registration statements, which meant a firm in the position of Lee Higginson would have faced direct legal exposure under the new rules. President Franklin Roosevelt signed the Securities Act on May 27, 1933. The Securities Exchange Act of 1934 extended the framework. It required ongoing periodic disclosure for companies whose securities were listed on national exchanges, created the Securities and Exchange Commission as the permanent federal agency charged with enforcing those rules, and gave the SEC authority to set accounting and auditing standards for public companies. Before 1934, no federal body held that mandate. Congressional debate over both acts cited the Kreuger case explicitly when legislators argued that investors had no practical way to distinguish a legitimate foreign issuer from a fraud when no independent verification was required. The Kreuger affair was not the sole cause of either law. Abuses by domestic institutions also drove the legislation. But the disclosure and auditing gaps the laws addressed were the specific gaps Kreuger had used. Before 1933, auditing of American companies was largely voluntary, and auditors typically reported to management rather than to shareholders. The Securities Act altered that relationship by requiring that auditors be independent of the company and certify that financial statements fairly presented the company's position in accordance with accepted accounting principles. Over the following decades, that statutory requirement helped build the modern public accounting profession and embedded the principle that auditors serve investors rather than management as a foundational norm of securities markets. That norm had not existed before Kreuger showed what its absence permitted. Every time you open a company's 10K annual filing on the SEC's eGuard database, you are reading a document that exists because Ivar Kreuger demonstrated what happens when no one is required to verify the numbers before investors hand over their money. The requirement for an independent auditor sign-off, the registration statement a company must file before selling new securities, the ongoing quarterly and annual disclosure obligations, and the SEC itself all trace a direct institutional line back to the failures the Kreuger collapse exposed. That does not mean fraud is impossible today. Enron and others showed it is not. But the baseline expectation that public companies must open their books to accountants who answer to shareholders rather than to management, and file those accounts with a federal regulator, is a direct response to a match merchant from Kalmar who convinced the world he could not possibly be lying.